The Canadian government built an account that gives you a tax deduction when you put money in and charges you zero tax when you take it out. It has been available since April of 2023. And right now, millions of Canadians who qualify for it have not opened one. Not because they do not want a home, because nobody told them the account exists. That account is the First Home Savings Account. And by the time this video ends, you will understand exactly how it works, who qualifies, what most people get wrong about the rules, and why opening this account today matters, even if you're not planning to buy a home for another decade. Let us start with the architecture, because understanding what this account actually is changes how you think about everything else. Every registered account in Canada operates on one of two tax models. You either get the deduction going in, or you get the tax-free treatment coming out. The RRSP gives you the deduction today. You pay tax on withdrawal later. The TFSA gives you nothing today. You already paid tax before you contributed. But everything that grows inside the account and every dollar you withdraw is completely tax-free. Those two accounts operate on opposite ends of the same tax logic. The First Home Savings Account sits in the middle. It takes the best feature from each side and combines them into a single vehicle. Contributions are tax deductible, exactly like an RRSP. Your taxable income goes down in the year you contribute. You get a refund. But when you make a qualifying withdrawal to buy your first home, that money comes out completely tax-free, exactly like a TFSA. No tax on the growth, no tax on the original contribution, no tax on the withdrawal. The government built an account where the money goes in tax-sheltered and comes out tax-free, and then attached a real estate purpose to it. That combination has never existed in the Canadian registered account system before 2023. And most Canadians either do not know about it or have not taken the time to understand why it is structurally different from anything that came before it. Here are the rules as they stand in 2025. The annual contribution limit is $8,000. The lifetime contribution limit is $40,000. That means the account has a 5-year runway at maximum contributions before it is fully funded. You can carry forward unused contribution room, but only up to $8,000 from the previous year. So, if you contributed nothing in 1 year, the maximum you can catch up with in the following year is $16,000, combining the current year's room with the full prior year carry forward. Unused room beyond 1 year is permanently lost. The account can remain open for a maximum of 15 years from the date you opened your first one, or until the end of the year you turn 71, whichever comes first. That 15-year clock is one of the most important and most misunderstood elements of this account, and we will come back to it. To be eligible to open a First Home Savings account, you must be a Canadian resident. You must have reached the age of majority in your province or territory. You must have a valid social insurance number, and you must qualify as a first-time homebuyer. The definition of first-time homebuyer under the First Home Savings Account rules is more forgiving than most people expect. You qualify if you have not lived in a qualifying home that you owned or jointly owned at any point in the current calendar year before the account is opened or in the preceding 4 calendar years, not your lifetime, 4 years. If you owned a home, sold it, and have been renting for 4 full years, you are eligible again. If you own a rental property you have never personally lived in, you may also qualify. Now let us talk about the tax deduction, because this is where the account creates real, immediate, measurable financial benefit that most people underestimate. When you contribute $8,000 to your First Home Savings account in a given tax year, you can deduct that $8,000 from your taxable income when you file your return. If you earn $80,000 in Ontario and you contribute the full $8,000, your taxable income for that year is effectively $72,000. At that income level in Ontario, the combined federal and provincial marginal rate on that $8,000 is roughly 31%. That contribution saves you approximately $2,480 in taxes in a single year. Do that for 5 consecutive years at maximum contributions. $40,000 of contributions. Total tax savings of approximately $12,000 to $15,000 depending on your income and province, in addition to all the investment growth that compounds completely tax-free inside the account the entire time. There's one important difference between the First Home Savings Account deduction and the RRSP deduction that most people do not read before they make their first contribution. With an RRSP, contributions made in the first 60 days of the calendar year can be applied against the previous year's taxable income. You can contribute in January or February and still reduce last year's tax bill. The First Home Savings Account does not work that way. Contributions to the First Home Savings Account are only deductible against the tax year in which they are actually made. A contribution on January 15th of 2026 reduces your 2026 taxable income, not your 2025 return. If you are counting on this account for a prior year deduction, the rules will not allow it. Now here is the part of this account that nobody explains clearly. It is the reason you should open this account today, not next year, not when you have money to put in, today. The 15-year clock on your first home savings account does not start when you make your first contribution. It starts the day you open the account for the first time. That is not the same thing. You can open the account, contribute nothing in the first year, and the clock is already running. More importantly, the contribution room is accumulating from that same day. Every year you hold an open first home savings account, you accumulate $8,000 in new participation room, up to the $40,000 lifetime cap. But that room only starts building from the year you open the account. Room does not accumulate retroactively for years before you opened it. This has a practical consequence that affects every eligible Canadian who has not opened one yet. If you are 24 years old and you think you might buy a home at 35, the optimal move is to open the account today, even if you cannot contribute a single dollar right now. The room builds while the clock runs. When you are ready to contribute at 30, you will have accumulated years of room waiting for you. Waiting costs you room you cannot recover. You can hold virtually any qualified investment inside a first home savings account. Cash, guaranteed investment certificates, mutual funds, stocks, exchange-traded funds, bonds. The same logic that applied to the TFSA applies here. Cash earns minimal growth. But the tax-free compounding inside this account is only as powerful as the investments you choose to hold. A broad market exchange-traded fund held inside a first home savings account for a decade before a home purchase will grow significantly more than cash sitting in a savings deposit. And every dollar of that growth comes out completely tax-free at withdrawal. Now let us talk about what happens when you're actually ready to buy. When you purchase a qualifying home, you make what the CRA calls a qualifying withdrawal. To make a qualifying withdrawal, you must have a written agreement to buy or build a qualifying home. You must intend to occupy that home as your principal place of residence within 1 year of buying or building it. And you must qualify as a first-time home buyer at the time of withdrawal using the same 4-year definition we covered earlier. The qualifying withdrawal is completely tax-free. No repayment schedule, no forms to repay over 15 years. The money comes out and it is done. And here is a detail that creates a significant opportunity for couples. 2 partners in the same household can each hold their own first home savings account. Both can make qualifying withdrawals toward the purchase of the exact same home. A couple who each opened accounts in the same year and each contributed the maximum annually for 5 years would have a combined $80,000 of tax-free money for a down payment, on top of all the tax deductions they received along the way. That is a genuinely material contribution to a down payment in any Canadian real estate market. Now let us address the first home savings account alongside the RRSP home buyers plan, because most people assume they have to choose between them. They do not. Both programs can be used simultaneously for the same qualifying home purchase. Under the home buyers plan, you can withdraw up to $60,000 from your RRSP toward a qualifying home purchase. But unlike the first home savings account withdrawal, the home buyers plan amount must be repaid to your RRSP over 15 years, or the outstanding balance is added to your taxable income each year. The first home savings account gives you the cleaner outcome. No repayment obligation. No 15-year clock attached to the withdrawal. The money comes out and it is finished. For someone who has built up both accounts, the strategic approach at the point of purchase is clear. Use the full first home savings account balance first. Supplement with the home buyers plan only if additional down payment funds are needed. This minimizes the repayment obligation you carry into the early years of home ownership, which tend to be financially demanding on their own. Now let us address the scenario that most people have not considered. What if you open a first home savings account, contribute to it for years, and then decide you are never going to buy a home? This is where the design of the account reveals its second major function. If the 15-year window closes and you have not made a qualifying withdrawal, you can transfer the entire balance of your first home savings account directly to your RRSP, or Registered Retirement Income Fund. That transfer is completely non-taxable. And critically, it does not use any of your existing RRSP contribution room. The money moves from the first home savings account into your RRSP as a separate contribution sitting completely outside the normal RRSP room calculation. You effectively contributed to the RRSP through the backdoor at a more generous limit than the RRSP's own annual cap would have allowed. What this means in practice is that the first home savings account is not only a home buying vehicle. It is also a legitimate retirement savings tool for anyone who contributes to it and ultimately redirects it. You receive the tax deduction on every contribution. The money grew tax-free for years, and it lands in your RRSP without touching your contribution room. The only thing you give up compared to a qualifying home purchase is the tax-free withdrawal. The RRSP transfer means future withdrawals will be taxable, but the deduction you received at contribution and the tax-free growth you enjoyed for the entire holding period remain yours permanently. This is the aspect of the account that makes it worth opening even for Canadians who are genuinely unsure whether they will ever buy a home. The worst case scenario is that you end up with additional RRSP funds you did not have before, funded by tax deductions you already received. That is not a bad outcome by any measure. The one question left is how the first home savings account fits alongside your TFSA and RRSP if you are using all three simultaneously. If you are eligible, the first home savings account should be funded before most other registered account contributions when you're planning to purchase a home. The combination of a deduction on the way in and tax-free treatment on the way out is the most efficient tax structure available on any single Canadian dollar in the registered account system. After that, the sequencing between your TFSA and RRSP depends on your income level. The previous video in this series covered that framework in detail. The action step from this video is straightforward. If you are a Canadian resident who has not owned a qualifying home in the past 4 years and you have never opened a first home savings account, open one today. Not when you're ready to buy, not when you have money to contribute. Today. The room accumulation starts the day the account opens. The cost of waiting is contribution room you cannot recover. The upside is an account that hands you a tax deduction, tax-free growth, and a tax-free withdrawal built into the same vehicle. This content is for informational purposes only and does not constitute personalized financial or tax advice. Consult a qualified financial advisor or tax professional regarding your specific situation.